First Bank. Ms. Sengupta, good afternoon and thank you so much for joining us here today on ET Now. Your first thoughts on the kind of WPI data that has just come in at about 0.13%. What was your estimate and what's the outlook going forward for the next few months as far as inflation is concerned?
We were slightly higher at around 0.5%. Definitely better than expected. It's led by decline in food prices, some similar trend that we saw in CPI also. Also, a continued decline in fuel, primary articles, etc., which has led to the slowdown in WPI. It also indicates that the GDP deflator, which is basically 65 to 70% of the composed of WPI, and the rest is CPI, was likely to continue to slow even in Q2. So we would get another, from a real GDP perspective, this would be the slowdown in the deflator would provide a positive boost to real GDP growth. It also indicates the fact that primary articles went down, fuel went down, also indicates that there would be some support from a margin perspective with input costs for producers continuing to reduce into Q2, which is again would be some support to listed company performances in Q2 from lower input cost pressures.
Okay, Gaura, thanks for your primary thoughts on that. I want to also talk to you about the core WPI number that we've got. Now, while we've seen a very big drop on the headline front, the core, it continues to be sticky, slight improvement, yes, at 1.3% compared to 1.7% on a month-on-month basis. But how are you reading this core number? Because you also have that one metric that we were talking about earlier on the fuel front. Manufactured products have come down, but yes, fuel and power, that is the one that continues to remain sticky. What kind of impact do you think this has on the entire core inflation number?
So the prices going down.
Gaura's feed, we'll try and patch with her once again, but we have more numbers trickling in on the WPI front, wherein you have the index numbers, wherein we've seen a decline in WPI food index. Primary articles WPI index is lower, so is the case with fuel and power, and manufacturing products WPI index is up 0.2%, the point that we were just trying to highlight. So that's the sense that we are getting from WPI, and we have Gaura back with us. And Gaura, yes, go ahead with what you were saying.
So just to add, like the manufacturing segment that you show, the manufacturing inflation, it's broadly stable. I'm assuming that if you remove food, because manufacturing products includes food, so if you remove food, it would have actually inched maybe a bit higher in September compared to August. So the decline in WPI is mainly led by commodity prices, food, fuel prices, raw material, metal prices, that is showing up in terms of headline slowdown in WPI. The fact that non-food manufacturing is holding up is a good sign. That is showing producer pricing power. The wider the gap is between non-food manufacturing WPI inflation and raw materials, which is getting captured by fuel and power, even and other components such as metals, minerals, etc. As long as the gap between non-food manufacturing and raw material cost that you can calculate from the WPI, as long as that gap is widening or remains wide, it indicates that at least from a margin perspective, there is some support from a sort of a value-added listed company performance. So I would say it's a positive that non-food manufacturing WPI inflation isn't falling that much. It's more a commodity price, both food as well as global fuel and commodity price decline, which is leading to our WPI slowing down. From a nominal GDP perspective, this easing in WPI means you see further slowdown in nominal GDP growth.
Okay, so further slowdown in nominal GDP growth is something that we should be prepared for. That's the word coming in as far as latest inflation figure is concerned. Gaura, thank you so much for taking your time out and joining us here on ET Now and giving us your thoughts on the latest inflation data. Thanks so much for joining us today.